QuickBooks Online 2021 forward contract for speculation that foreign currency will strengthen initial transaction. Let's get into it with Intuit's QuickBooks Online 2021. Here we are in our QuickBooks Online practice problem 2 multiple currencies forward contract practice file. In prior presentations, we set up the 30-day free trial, then turned on the multiple currencies by going to the cog up top here, going to the accounting and settings, and then we went to the advanced settings, turning on the multiple currencies, the US dollar then being our home currency. Closing this back out. Now we're going to be setting up then our initial kind of transaction. Let's first think about that within Excel. So let's go on over to Excel, and we're going to go to our practice problem tab over here and enter the initial transaction. Here's this scenario. So on 12/1/X1, U.S. company entered into a 120-day forward contract to purchase Australian dollars. So what that means basically is we did a speculation contract. We're thinking that the Australian dollar is going to be stronger in the future in relation to the US dollar, and therefore we want a speculation on that. How do we speculate on that? Well, we would like to be owed Australian dollars in the future. We would like to have a deal where we're going to get paid in Australian dollars in the future, and because we think the Australian dollar is going to increase in value, when we get paid at a future point, it'll be paid more than the current transaction we're going to set up in the current day. So if we go to an exchange broker, we can actually set this up and say, hey, look, what I'd like to do is get paid, we're going to say 100,000 Australian dollars in the future, and I would like to then pay you, I'll pay you the same amount in US dollars, the equivalent amount in the future. We would like to say based on the current exchange rate, but we're going to have to use some kind of speculative rate to do that, and that's where the kind of little bit of a funny part will be. So we're going to say, okay, well, if we go to the broker, we're going to say, all right, what we want is a receivable. So we're going to say it's going to be an accounts receivable that we're going to be putting on the books. And we're going to call that then the receivable here. It's going to be this item. Very long name. We won't have such a long name in QuickBooks, but it's a foreign currency receivable from the exchange broker. So we're basically saying from the broker, we're going to be receiving the equivalent of, 100,000 foreign currency units. And we're going to have to then value that on our books in some equivalent portion for the US dollars. Then we're going to be paying in the future at the same point in time. We're going to be paying then in Australian dollars. So we'll play the dollar payable to the exchange broker. This is going to be in dollars. So the key point here is we're going to be receiving this in the future. We're going to say the future will be, we said 120 days, which will be on 3/31/X2 of the next year. We're going to be paid then 100,000 Australian dollars, and we will then pay the broker whatever we promised to pay in US dollars at this point in time. So you would think then what we would do, let's pull out the trusty calculator, is that we would, and this is what we would do in a normal transaction, we would say, okay, we got the 100,000 that in the future that we're going to get, let's multiply that times the spot rate, 0.6. And that would be 60,000. That's what you would think would happen, because that's what would happen normally if it was like a normal business type of transaction. Say we made a sale on account, then that's what we would typically do. But because this is a speculative transaction, the exchange broker is not going to accept that. They're going to say, hey, look, that's the spot rate right now, if you were to exchange right now. But it's speculated that the forward rate will be this 0.609. So now we're going to have to use some other rate. It's not a spot rate, it's a forward rate. Remember that the spot rate is what it is. That's what it is at this point in time. That's what the difference is between the currencies, because that's what the market is currently doing. The forward rate is a speculative rate, but it's still market-based. The market is speculating what they believe the rate will be, and that's what, of course, the broker is going to want to be using here. So that's going to be the difference. We're going to have to use this rate. When we pull that rate in QuickBooks, QuickBooks won't give us that rate automatically, most likely, right? We'd have to get that and negotiate it with the broker. QuickBooks will typically give us the spot rate because it knows what the spot rate is. It doesn't typically calculate for us the forward rate, which we would have to then get from the broker and be up to date on that. So if we put this on the books, then we got to take this 100,000 that we're going to get in the future, and we're going to multiply it not by the spot rate, but the forward rate. And that's the difference. So that's going to be our receivable and our payable. So if we put this on the books then, let's put this on the books. We're going to say then we've got the receivable, which is going to be equal to this 60,900. And we've got then the payable, which is going to be equal to the 60,900. No net change at this point in time. Obviously, we expect to be receiving, we're going to get 100,000 in foreign currency units, which we valued in the US equivalent here at the 60,900, not with the spot rate, but the forward rate. That represents what we're going to get in foreign currency units, 100,000 foreign currency units. Therefore, this one will change and vary over time as the rate changes in relation to the US dollar. This one, we promise to pay based on today's speculative rate, forward rate in the future, 60,900. This one will not change. So therefore, if the foreign currency units get stronger, the Australian dollar gets stronger, and we get paid in Australian dollars, then we gain. We have a gain on that. If the Australian dollars get weaker, then we've made a bad speculation and we've lost on it. So now what we got to do in our books then is set up these accounts so that we can then record these transactions on our books. Now there's a couple ways we can do this. If I go back on over to QuickBooks over here, note that in the desktop version, if I go down to the accounting tab, normally if I was using the desktop version, we're on the online version, you usually use an account that is going to be a foreign currency account. So if I was to say new up top, we would typically want to be using like an accounts receivable account or an accounts payable account, because those are the ones that have the foreign currency transactions units in it. The problem with it, one of the kind of difficulties with those two accounts is that typically we use those accounts in relation to forms, receivables, an invoice, payables, a bill, to populate those forms. We don't typically enter journal entries to that. And so we could do that. We could do that and then basically use that as transactions. And then of course we have to track the customer and vendor as the subledger. But the other way we can do it is basically to just have a normal kind of journal entry. And for QuickBooks Online, because it doesn't have that automatic kind of update process for the adjusting entries, the journal entry might be the easier way to go. So we might just set up then a receivable and a payable type of account and record the transaction just simply with a journal entry. So I'm going to try that method here. I'm going to hit the drop down and we're going to set up basically an asset account, and I'm not going to call it then an accounts receivable account. I'm going to call it an other current asset so that I don't have to deal with a customer and a subledger and the fact that we typically use invoices. There's restrictions to the receivable account that we don't have with an other current asset type of account. And then I'm simply going to call it then an other current asset type of account. And then I'm going to call it a receivable exchange broker. And I'm going to put AUD because it's going to be in Australian dollars. Now we have the option here to change the account to be in US dollars or some other dollars, but I don't think we want to do that. We're going to keep it in the US dollars. And let me just show you why real quick. If I duplicate the tab up top, if we right click on the tab and duplicate this tab, just so we can take a look at what the journal entry will look like so we can see what we're doing here. If I hit the drop down and we then go into the journal, this would be a journal entry. How we're going to record this is going to be with a journal entry. Then you can see here we've got the currency up top, and this is where we would want to set it to the foreign currency. So we would set this to the foreign currency, and that'll give us basically our exchange information. And then down here we could set our accounts, which I believe are going to be in the US currency amounts, and that's how we're going to work it. So although we have the option here, we're not going to be changing it. I'm going to say, even though this one is the one that is going to be representing the fact that we're going to get paid in foreign currency units, so I'm going to save that. And then I'm going to set up another one, and this is going to be a payable. So I'm going to say that this is going to be an other current liability type of account instead of an accounts payable account. I'm just going to call it other current liability, and I'm going to call it broker payable and USD for the US dollar. Once again, I'm not going to change the currency for it down below. We're going to save and close that. Now let's basically add the Australian dollar to our currencies. We could do this basically as we go. A couple ways you can do it. You can go to the cog up top here. We can then go to the currencies, and we could then add the currency here. This is probably the most formal way to do it. The other way we can do it is just as we enter the transaction. So let's go ahead and enter the journal entry and try to add the currency as we go. So I'm going to go to the second tab over where we added the journal entry. Just to see that again, we go to the plus button, we go to the other, and we're going to enter then the journal entry. I'm going to make the journal entry now. I'm going to try to add the Australian dollars basically as we go here. So the Australian dollars is AUD, Australian dollars. There's the one. Adds that, and it gives us our exchange for us at that point in time. The date we're going to put here is 12/1/01. So I'm going to say 12/01/2021. I'm actually going to make it 12/01/2020 in the prior year. Then it gives us our exchange rate. Now this is a practice problem, so I'm going to change the exchange rate to what we think it should be. Now note that even in real life, QuickBooks would give us kind of like the spot rate on that. And we would typically have to change it because we're not using the spot rate. We would have to use the rate that we negotiated with the exchange broker, which would be some kind of forward rate. So we'd probably have to change it in practice anyways, which is going to be the 0.609. So I'm going to say 0.609. Now this obviously isn't an actual rate. We're just using it for our practice problem. So I'm going to say save it. And then we're going to say the receivable was that receivable we set up for the broker. So we said receivable exchange broker. And I'm going to put this in the 100,000 foreign currency units. We probably could put then in a description, but I'm not going to here. And then I'm going to say the other side is going to be a payable that we set up for the exchange broker. And so there is that. So that puts it on the books for the 100,000 Australian dollars. You can see down here, US dollar equivalent to 60,900. So this represents the fact that we're going to get 100,000 in foreign currency units in the future. And this one shouldn't be the receivable. This should be a payable. This is broker payable. And then we're going to pay the broker, there it is, in US dollars in the future. And it's going to go on the books for the 60,900. All right, let's save it and close it and see if it does what we expect it to do. Save it and close it. And then I'm going to open up the balance sheet and say, let's see if it does what we expect it to do. We have expectations from you, QuickBooks. Let's see if they have fulfilled our expectation. By going to the balance sheet down below, we're going to open up the balance sheet, close the burger, hold down Control, scroll up just a bit. We're in, let's bring this back to last year. So I'm going to say this will be January 1st, 2020 to 12/31/2020. We're going to say, let's run the report. So there we have it. So now it's on the books at that 60,900, 60,900 on the receivable. Going back up top, the other side then is on the payable, And it looks just like what we have. Let's open up the trusty trial balance now. Right-clicking, duplicate. Take a look at the trusty TB, trial balance. Nothing's more trusty than the trial balance. And we're going to go down to the reports on the left-hand side. And then we're going to go then to the trial balance. So you got the BS balance sheet, but then you got the TB trial balance. That's trusty. So we'll change the dates up top. Running it for 2020. This is what we have thus far. That matches out, I believe, to what we have in our Excel worksheet. We do want one other thing. We should put just the 100,000 on the books for our practice problem. So I'm just going to add that in US dollars just so we have that. So I'm going to go to the first tab, hold down Control. Let's just put 100,000 that we can play with here. So we're going to say I need an account. So I'm going to go to the accounting. I'm going to say new, and let's put a checking account in there. This is going to be a checking account, normal checking in US dollars, USD. So let's save that, and then let's just put 100,000 on the books so that we have money to do stuff with. Can't do too much stuff without money. And then I'm going to hit the drop down. This is going to be a deposit, and we'll put this on there as of January 1st, 2020. We're going to say, and this is going to be a deposit of 100,000. Other side, I'm just simply going to put to the equity account here. So something like a retained earnings. There we have it. Let's save that, and then check it out. Back to the trusty TB, running it, and there we have it. So now we got the 100,000 cash, other side in equity, and then the receivable and the payable. That matches what we have here on Excel. So I'll be printing out these trial balance eyes so that you can look at them as we go through the practice problem.